We'll continue looking at the overbought and oversold zones in this examination of a slightly more complex oscillator which also incorporates them in its search for reversal. It was developed many years ago by George Lane. Nevertheless, it's been making something of a comeback recently because of modern technology. What's 20 years between friends? The principle of the stochastic oscillator is based on the tendency that, with a general price rise, closing prices as a rule converge to the upper boundary of the price range. And vice versa, when there is a downtrend on the market, they converge to the lower boundary. Several curves are used in this oscillator. The main curve is called percentage K. Stochastic determines the level of the latest closing price relative to a price range for a certain period of time. This is the indicator's first value, N1. The most widespread period used for this curve is 5 days, or hours or weeks. The formula of this curve is strikingly simple. Here it is. It helps determine the position of the last closing price in relation to the lowest price L5 and the highest price H5 of the range for a selected period of time. We've chosen 5 days. The K curve is very sensitive to price change and it spends a lot of its time banging its head on the floor or the ceiling. Which is why we don't feature it in rumours. But if we average it, for example over 3 days, we get a slower curve. 3 days is the second oscillator's time period, N2. We'll call the new curve a slow percentage K line, although it'll be the fastest one on our stochastic chart. And here it is. And after averaging or smoothing the new percentage K line for 3 more days, we get a percentage D line, and the third and last time period, N3. We'll chart percentage D as a dotted line on the chart. And that's it. Plotted it at last. So what have we got? 2 lines, a slow percentage K and percentage D. In addition to this, we have 3 time values. N1, 5 is the customary value, and N2 and N3, they're the smoothing periods. We've set them both at 3. And you can play around with them. Your computer will help you again. The K and D curves fluctuate between 0 and 100 on the vertical scale. The overbought and oversold zone should be set with signal lines drawn at 30 and 70. And how does this oscillator generate trading signals? At first sight, in the same way as the previous indicator, RSI. The first type of signal appears when the K curve leaves the critical zone. If we've set the overbought level of 70, then when the K line crosses the level from above, it's a signal to sell. If the K curve crosses the oversold level of 30, it's a signal to buy. The second type of stochastic trading signal is when K and D cross. Let's see what they generate. Whoa, maybe there are too many signals. We shouldn't jump to conclusions. Well, to start with, let's go back to the idea of divergence. Divergence in stochastic is a discrepancy between the price chart and line D. There are examples of bullish and bearish divergences given on these charts. They look similar to those of the previous oscillator RSI. When a divergence of line D in the price chart occurs, the crossing of lines K and D gives a most significant trading signal to buy or sell. let's use other time parameters to examine some special features of stochastic. 14, 5 and 3. These values were put forward by technical analyst Thomas Birwitz. A moment ago I said that divergence on stochastic looks similar to divergence on RSI. Similar but not the same. Do you remember the principle that stochastic is based on? Closing prices come closer to the upper boundary of the range when the trend is bullish, and to the lower line when the trend is bearish. Which is why with a strong uptrend on the market, the stochastic entry into the overbought zone looks very special. Do you see what I mean? It seems that line D is endlessly moving from 70 towards 100. But that can't happen. The market needs to have a breathing space and consolidate before reaching its top. And at that moment line D leaves the upper zone and starts falling. This signal is usually ignored. D returns to the overbought zone and can form a divergence, and the crossover of K and D provides an excellent shorting opportunity. Great help with filtering these signals can be had from the price support and channel line and from the alligator, both of which we discussed earlier. Take a look. Just like we did with RSI, a support line is drawn on the stochastic chart. After breakout, support becomes a resistance line and causes a divergence. And now let's examine an example of a bearish divergence. We have a typical entrance into the critical zone. The indicator then leaves the zone briefly, and there's the divergence and the buy signal. Let's just take a look at the lines that form the borders of the price channel. The combination of stochastic signals and chart analysis makes the trader's life easier. So what typical characteristics does stochastic have? This pattern has its own name, the hook. Usually it occurs around level 50, and often it happens at the very beginning of a strong trend. We can only identify a hook or anticipate its appearance by watching price activity within the price channel. It may occur after a breakout on the support line, or, as we can see here, a breakout on resistance at the beginning of the uptrend. It says a lot that Lane, the inventor of stochastic, recommended using it for studying long-term price dynamics, and he suggested plotting stochastic for weekly charts and taking the readings into consideration when looking for trading opportunities on daily charts.